We are off to the races after a beat from Nvidia, a beat from Walmart, and a blowout jobs number. 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up, Nvidia's bullish forecast reignites the AI trade and calms bubble fears for now.
And everyone rejoices. Stocks get another boost, not just from that, but a stronger than expected jobs report, with the data reinforcing bets that the Fed will hold next month.
And the world's biggest retailer, Walmart, warns that higher costs are coming, but it's feeling good about business overall.
By the way, I don't know if this necessarily reinforces that the Fed won't cut because the unemployment number was also higher. So you can take from it what you will. But here's one thing that is having a decisive move, and it is Nvidia. In the pre-market, it did not disappoint. Shares up 5%. It's expecting sales of about $65 billion in the January quarter and more than $500 billion in revenue in the coming quarters. That outlook made it clear that it still has lots of buyers for its products, soothing fears of an AI bubble. But if lots of people are buying and spending money, wasn't that like kind of the problem to begin with?
Yeah, and don't forget that we now have more layoffs to talk about from Verizon with regards to the potential Fed cut. Walmart boosted its sales outlook for the year as it gains market share from all income groups. Its push into e-commerce and AI helping broaden its reach. You can see the shares up 3 1/3%. It did, though, once again, coming back to the Fed story, warn of inflation. So, there's, on the one hand, you've got more job cuts. On the other hand, you've got inflation warnings.
Yeah, it did, though, also warn, as is the tension in this economy, that lower income consumers were feeling pressure too. By the way, Matt, back to big tech. Nvidia CEO Jensen Huang spoke exclusively with Bloomberg after yesterday's earnings release. Here's what he had to say about chip demand.
We've done a good job planning for a very, very strong year, and we've done a good job planning for Vera Rubin. So sales are off the charts. Nvidia GPUs in the cloud is sold out, but we've got a bunch of Blackwells to sell.
Let's bring in the man who did that interview. It's Bloomberg Tech's Ed Ludlow. So, Ed, the numbers, Jensen Huang, a soothsayer for this market. But is it enough to allay concerns that this is an industry that is over-investing and there might be problems to come?
Seems like it based on the other names that are moving this morning as well as Nvidia, right? So if you look at the neo clouds, CoreWeave is an interesting example given what Huang said in that answer, which is that all of the Blackwells they've already shipped are being fully utilized. Whoever has got Blackwell installed in a data center somewhere is running workloads on them to the max. And he kind of hit the trifecta because he said, here's the demand outlook, $65 billion in the fiscal fourth quarter. But as he explained just then, they also hit the supply issue as well and are very confident that this $500 billion figure, which runs through to the end of calendar 2026, could get even bigger if they are able to free up more supply of Blackwell chips and Vera Rubin comes online. The final piece of the trifecta is he also had some fighting talk about customers who looked at other chips, either from other GPU providers or maybe ASICs, Google's TPU, for example, and then kind of came crawling back, and the market loved to hear that.
This is a stock, Ed, as you well know, it's up 1,300% over the past 5 years. So the rise has been meteoric. But, the first thing I thought of when I saw the numbers yesterday is that it's not knocking the cover off the ball the way it used to. Beating on a forecast level by only single digits is not the same as it used to be 20, 30, 40% better than the street expected.
Correct. But now we find ourselves in a slightly ironic position where Nvidia does not formally give guidance. So this $500 billion figure, which is just Blackwell and Rubin and does not include China at all, is probably a bit conservative. The analysts really went for that on the call, and we tried to get Jensen Huang talking about it in the interview. How much bigger could that number get and what's behind it? But if you consider that it was a forecast over a six financial quarters period, 2 of those quarters have gone. They'll basically do $350 billion of sales just on 2 products in the next 12 or 14 months. And that has given the market a lot of confidence. That means that whatever the street had modeled for the balance of 2025 or in the 9 months prior to yesterday, they were really, really behind it. You know, Nvidia is tracking well ahead of consensus.
All right, Ed, thanks very much for the interview. It was a fantastic job, and I'm looking forward to your programs today. Bloomberg Tech's Ed Ludlow, his program kicks off with Caroline Hyde at 11 a.m. The other story, one of the other stories driving markets today is the September jobs report. The shutdown-delayed data showed U.S. jobs growth picked up, beating all estimates. Let's break it down with Michael McKee, Bloomberg's international economics and policy correspondent. So it looks pretty strong from the headline number, Mike.
That depends on whether you think the Fed should cut rates or not. And this doesn't change the Fed's problem of having a really divided group, because total payrolls did come in at 119,000, higher than anticipated, about double what they were anticipated to be. But total payrolls in August revised down to a loss of 4,000 jobs, and I think that's gotten the market's attention, and one reason that stocks are rising. Private payrolls were pretty good. We know that a lot of people fall off in October, the federal payrolls. The unemployment rate, though, went up, and it's only 6 basis points below, rounding up to 4.5%, which would get people's attention. The way we were, this is the way we are now. Initial jobless claims also out today. 220,000 shows that there's not a lot of firing going on at this point. It's still a low firing economy. A little bit of an uptick in continuing claims. Better news from the Philadelphia Fed overall, but their prices paid number rises. So inflation is rising, and we saw that in the Walmart numbers today, the Walmart announcement. So here's what we have ahead of us. October payroll is going to be released with the November payrolls on December 16th, but only the number of jobs created from the establishment survey. The household survey data wasn't collected, no unemployment rate. So the real question now is, if you think that the labor market is getting better because we had an increase in jobs in September, then you think the Fed doesn't need to cut rates. If you think it's getting worse because unemployment went up, then you think we do need to cut rates, and it really isn't going to settle the argument.
I'm guessing it does the same for the Fed then. For those FOMC members who believe that they should cut or shouldn't cut, I'm guessing this just gets us to a place where the hawks continue to weigh out because they've been the loudest.
Yeah, and we know that the October number, even though we won't get it in time, is going to be terrible on the headline basis because of the federal workers falling off. The question is, on the private payroll side, did we see an adequate number or not? And we just won't know. Fed's not going to have any more data. The only thing that they're hoping at this point is maybe BLS can get CPI out, but they're not keeping they're not holding their breath.
Can't they just delay their decision to wait for the data? Won't it come out shortly after the Fed decision? Why not just knock it back by a week or two?
That's actually a really
right? Why
good
couldn't
point.
they do
That's
that?
a lot of flexibility here.
A lot of people on Wall Street are raising that issue and suggesting that happen, but the Fed is not going to do that. I don't think they're going to pretty much stay on schedule. They all have their own individual schedules, and they're built around what the Fed.
They just want to go home for Christmas. Is that what you're saying?
Well, yeah, like everybody does. So I don't think that's going to happen.
All right, Mike, thank you very much. Bloomberg's Michael McKee after that jobs numbers. And later in this hour, we will be speaking to the Labor Secretary, Lori Chavez-DeRemer, after those numbers coming out. Now let's move to the consumer, with Walmart boosting its sales outlook for the full year, but also warned that higher costs from tariffs are coming. We've heard this one before. Bloomberg's managing editor for global business, Shelley Banjo, joins us now. And Shelley, maybe that's why initially Walmart sold off. Up now more than 3% in the pre-market. What was your takeaway from what we heard?
Yeah, I think that stock traded down initially because the raise wasn't as high as people were expecting. Walmart has been known for the last forever, but definitely over the last few quarters to sort of the beat and raise. And so they didn't feel as, confident as many investors were happening. Then you saw the call happening. You saw a lot of positive words like positive, encouraging, so far so good language, and you saw that stock tick right back up.
What do we hear from Walmart about inflation? Because it's clear that not all companies have passed on tariff costs to consumers, but they're starting to do it more and more.
Yeah, so Walmart said we took a balanced approach. We absorbed some of the costs and we pass along some of the other costs, especially in things like, goods that non-grocery goods. So, games, computers, things like that. And so across the board, they saw a 1% increase in prices across the board for them. But they're saying grocery prices are starting to settle a little bit. Not everywhere. Beef is still very high, but egg prices, things like that, coming down a little bit.
All right, Shelley, thank you very much. That's Bloomberg Shelley Banjo. And of course, there was the news too that Walmart is going to be moving to the Nasdaq because it's now a tech-focused company. And just bringing around to the news at the top of the hour, Matt, with Verizon laying off 13,000 workers. In that, they also talked about some of AI making a difference in letting go some of their workers.
Yeah, well, I mean, that's going to be continue also on a one hand and the other hand issue, right? Because it's replacing jobs, but also should be boosting productivity. So we'll see how well that works at Verizon.
Yeah, but is it just an excuse? It sounds better than to be like, you know, we just want to lay off people because we want to have better margins.
Right before Christmas.
Yeah,
we did see a huge spike in mass layoffs in October, so I'm definitely keeping my eye on that story. In terms of what's going on with futures, though, the market likes this. Everything is up. In terms of risk assets, you have gains on equity index futures right now. S&P futures up 1.5%, NASDAQ futures up 2%, but we also see a rally in bonds. You see gains in crude. You see gains in gold. Bitcoin is up as well, so...
Good day to be long everything.
Yeah.
Some of the other movers on our radar. Okay, not everything. It's a bad day to be long. Bath & Body Works, they cut their full-year outlook due to weaker consumer sentiment and the expected impact of tariffs. The CEO also went on the call and said, it's not my fault. It's the prior CEO who had a super bad strategy.
What are the impact of tariffs on bath bombs?
I don't know. They have other stuff besides bath bombs.
Okay, I haven't been there in 25 years. Abbott will buy color guard maker Exact Sciences for about $21 billion, the biggest deal of the year in the global health sector, and it doesn't come on a Monday.
It's fancy that. It is a deals day today. Anyway, Palo Alto Networks, by the way, they also announced a deal on this decidedly not Monday. The shares are down. They had earnings. They did boost their forecast, but also announced a $3 billion deal to acquire Chronosphere. And again, Matt, as we mentioned, there's Verizon shares too.
Right. The Verizon layoffs, 13,000 in the announcement. It hopes to invest more in products that attract more customers. That makes a lot of sense, I would say, for a running operation. Verizon shares down 1/3%.
All right, coming up on the show, BNP analyst David O'Connor says Nvidia remains in a strong position for megatrends in generative AI and autonomous cars. He's going to join the show next on his breakdown of Nvidia earnings. That's next on Bloomberg Open Interest.
Getting out of high interest, look what's making headlines around the world. President Trump will meet with New York City Mayor-elect Zoran Mamdani at the White House tomorrow. Mamdani plans to push for help on housing and cost of living issues, while Trump has warned he'll pull billions in federal funds over Mamdani's tax and spend agenda. The face-off between two political opposites is shaping up as an early test of how Washington and the nation's largest city will coexist. Although they do have a lot, actually, in common. Blue Owl Capital scrapped plans to merge two private credit funds after investors balked at potential losses. The reversal comes as shares hit their lowest since 2023, with co-founder Craig Packer blaming, quote, negative articles for the slide. The move spotlights rising pressure across the $1.7 trillion private credit market as redemptions mount and scrutiny grows over risky lending. Blue Owl now says it's exploring ways to give investors liquidity, including possible asset sales or a public listing of its non-traded BDC, the one that kind of caused the problems in the first place. Short seller Carson Block says now is not the time to bet against big U.S. tech like Nvidia, despite growing warnings of an AI bubble. He joined Bloomberg Television earlier.
If you're out there trying to short Nvidia or any of these big tech names, you're not going to be in business very long. So there are, when I look at AI, you have all these AI adjacent companies, you have these AI player or AI pretenders. That's where you would want to look to short. However, so long as the leaders such as Nvidia are still going up and to the right, I think that would be a very dangerous trade.
Nvidia's outlook suggests that its $500 billion revenue expectations may be bigger than expected. CEO Jensen Huang told Bloomberg how its Blackwell chip is driving growth.
Sales are off the charts for Blackwell, and Nvidia GPUs in the cloud are sold out. We got plenty of Blackwells to sell you. We have lots of Blackwells coming. We're making a lot of Blackwells, and we have a bunch of Vera Rubins coming. And so business is very, very strong.
My first reaction to that interview, what happened to his leather jacket? I guess he had the suit and tie to meet the president. Joining us now is BNP Paribas equity analyst David O'Connor, who has an outperform rating on Nvidia and joins us now. David, great to see you. Thanks for joining in studio.
Thanks for having me.
So essentially, okay, Nvidia reveals that big tech was spending a lot on AI in the third quarter. It's nothing new and it's nothing surprising. Why is that enough to calm market fears?
Yeah, you're absolutely correct. Solid numbers, but that was to be expected. Single-digit beats. I mean, no one's running out and buying stocks when you're just beating by single digits. I think what's the most important thing was the messaging around 2026 here. And the company came out and gave a very strong demand signal on 2026, talked about essentially being sold out on GPUs, supply constrained, and also within that 500 trillion you mentioned, you can back out this year, and it implies around $320, $350 billion for the data center business for next year. So very strong growth forecast, again, for next year. And we needed to hear that messaging given the concerns around the AI capex bubble that has kind of led to a correction in the last couple of weeks.
Well, Jensen delivered in terms of the positivity that was needed, both on demand and on supply. Are we past peak GPU pricing power?
I think not yet. While the supply chain is still constrained and demand ahead of supply, they still have pricing power in their pocket, and also on their roadmap, once they can deliver better performance per watt going forwards, that kind of leads them to better pricing. So while you're constrained, I would say better pricing is set to continue. So better units from bigger supply chain, and also better content due to better, more performant chips.
So for now, we can continue to rally and the bubble talk concerns get pushed to the side. But David, does talking about a bubble miss the point? Is it more about the financial health of these AI labs, of Anthropic, of Open Interest? Rather, Open Interest is here. We're not spending on Open AI. We're not spending on data centers as far as I know. But Anthropic, all of them to continue to raise these giant amount of fundings to push into that spending. Is that not the real concern? Do we not need to address that head on? And what happens if they can't keep raising huge trillions, numbers of money to continue to build out AI infrastructure?
Yeah, look, essentially there's three questions we keep getting from investors right now around AI names. Number one is, are we in the AI infrastructure bubble? Number two, who's going to fund this, to your point? And number three, AI monetization, like show me the money, who's making money out of this? That's front and foremost for investors at the moment. And I think last night we got some answers, or certainly Nvidia tried to kind of address those concerns. Now they don't go away, but certainly kind of eased concerns from investors. And I think, on the first point, are we in the AI infrastructure bubble? I would say we are in an AI news flow bubble right now. Maybe not quite an infrastructure bubble. There certainly is a bit of a disconnect between the two, because essentially, we're most constrained here on power availability. That is the biggest headache for CSPs, biggest headache for Nvidia and their customers.
Wait, is power the biggest constraint or funding? I mean, if
right now power is the
Altman
biggest.
wants to spend 1.4 trillion, but he only has 13 billion in revenue, where does he get the other, 1.39 trillion.
No, that's a good point, Matt. And but you have to look over what time frame is that, right? I mean, we're all cognizant of the fact that data center number 2 doesn't get built until data center number 1 gets kind of filled up, essentially. So it will take time. So don't read too much into that 1 trillion. I mean, that's where we're going, right? That's a kind of aspirational. But in again, going back to kind of the reality, that disconnect between what the news flow would suggest and what actually can be rolled out in terms of standing up new data center capacity, it all takes time. And that's important here as well, because it gives us maybe more time to answer point 3, which is the AI monetization.
Yeah, like who's actually who right now, that's not Microsoft, or other big tech companies, actually making real money on this?
Yeah. I mean, that's front and foremost for investors. I would say, we started to see kind of a split within AI into kind of previously with the accelerated kind of AI. Now we're moving into a bit more generative AI. And then next is kind of agentic AI. On the first point, there's already monetization, there's already ROI on that. You can see hyperscalers, for instance, social media companies, better click-through rates, better market share, more screen time for users. So that is a ROI right there.
Is that enough to fill the gap should funding markets seize up, or at least become more complicated? You're already starting to see some of the fears. Oracle CDS spreads have started to widen out, doubling just over in the past month. If that funding market disappears, do these hyperscalers have the ability to get that monetization to replace it?
Well, I think on the second 2 points on generative AI and agentic AI, we haven't seen much in terms of monetization of those two yet. So the funding that has been done already by CSP has justified the kind of ROI that we've seen from essentially recommender engines. But the funding that's kind of coming next year and beyond that, we really need to see monetization on generative AI and agentic AI. And that is where there's a big question mark and not clear exactly what those business models will look like and how much revenue can be generated off that.
Well, we appreciate you holding our hands through this fog. David, great to have you here. Great to get your intel and your take. BNP Paribas equity analyst David O'Connor talking to us about Nvidia and really the broader AI bubble debate. Coming up next hour, we'll discuss AI infrastructure and energy with Stonepeak's Mike Dorrell, who runs the largest privately owned infrastructure investment firm. This is Bloomberg Open Interest. Check right now on futures ahead of the opening bell. After an Nvidia beat, a Walmart beat, and a jobs beat, we have gains of 1.5% on S&P futures, more than 2% on the Nasdaq. So less than 4 minutes to go until the opening bell rings. RaeAnn Mitrione of the Callan family office says Nvidia earnings reinforced her optimistic view, and she joins us next. We are moments away from the start of trading on a very bullish day for risk assets. You can see futures up more than 1.5%. On the Nasdaq, a 2% gain. The small caps gaining 1.5% as well. We've got kind of a SPAC attack here on the New York Stock Exchange. Viking Acquisition Corp ringing the bell, and down at the Nasdaq Central Bank Company, which is an very old company, I think 129 years old, but they also raised over $300 million in a stock sale. Dani, we're watching the big one today.
It's kind of like the only thing we're watching, maybe jobs too, but I mean, it's the stock of Nvidia helping to lift the overall market here at the open, up 4.5%, and it didn't disappoint. Sales of $65 billion in the January quarter, more than $500 billion in revenue in the coming quarters, and that outlook made it clear that it still has lots of buyers for its products, soothing fears, at least for now, Matt, of an AI bubble.
Yeah, we're also watching Walmart boosting its sales outlook for the year as it gains market share from all income groups. I was going to say it's not an AI company, but Walmart's push into e-commerce and AI, those pushes are helping broaden its reach. It did warn of higher costs, concerns about inflation then. I wouldn't say front and center, but still existent there at Walmart. And speaking of macro, let's turn back to this morning's jobs data. Jobs growth accelerated in September, showing signs of a stabilizing labor market before the government shutdown. Joining us to discuss, we are pleased to say, is the U.S. Labor Secretary, Lori Chavez-DeRemer. Ms. Secretary, thank you so much for your time this morning. Let me first ask you about the headline number. It was a blowout. We were only expecting 51,000 in our survey, and far more than double that is what we got. How strong is this economy?
Well, 119,000 new jobs. I think that is a solid report for the American people and for the workforce. We have seen over and over again, that we want to have these gains, and it's those investments by this administration and this president, I think that's what you're seeing come online. So this was a solid report for the September numbers. We'll have to see how November numbers come out in mid-December, but I think that this is good for the American people. We know that more people are wanting to work and they're actively seeking those jobs. And so it is my responsibility to make sure that we have that skilled workforce. And so I think that you're going to see consumer confidence. And again, with prices coming down, energy prices, gas prices, We're seeing, real wages go up. Blue-collar wages have gone up over the last 60 years. And I think that that's the exciting part of this, is that we're seeing people who are wanting to get on the ground, have the skills that they need, and get in the workforce.
Secretary Chavez-DeRemer, you might sound very similar to those who don't want this Fed to cut, that this is a healthy labor market. The president, though, even jokingly yesterday was saying Scott Bessent would be fired had he not been able to get this Fed to cut. So in your view of this labor market, is it strong enough that it doesn't need assistance from the Fed?
Well, I think the president has been pretty clear on this issue. We did see the 2 rate cuts. I think the Fed does need to go ahead and cut again. You know, when I travel around the country talking to businesses, which I have hit 36 out of 50 states on my 50-state tour before, the Democratic shutdown happened, those business owners are wanting to borrow more money at a cheaper rate to invest in their workforce. That is what they're asking. And so I think another rate cut is exactly what we need to really grow this workforce. I mean, we see GDP is up 4.2%. I think that that's positive growth. And we want to see more private sector jobs come online. Out of the 119,000 jobs, we saw 97,000 of those jobs have been in the private sector, which is way different than the Biden administration when we saw they were all government jobs. So I think we're on the right track.
It does seem like inflation is a concern. We heard that from Walmart today, that it's got to pass through these tariff costs somehow. Are you not worried that we have a rise in inflation that hits lower income workers especially hard if we continue to cut rates?
Well, I think what happens when you're talking to the American families every day, they want affordability. So they look for ways in order to provide for their families. As a former congresswoman and as a former mayor, I know how important that is each and every day. What we want to do is grow this workforce so that they can have more money in their own pockets. These policies that came forward with the working family tax cut are going to start to hit. No tax on tips, no tax on overtime, no tax on Social Security. I think that that's what people want to see, is more of their hard-earned dollars in their own pockets for their own choices. We've seen, again, these real wages go up. Almost $700, and I think that that's going to be key. Way different than the Biden administration, when wages were down almost $3,000, and so to have $700 more in a family's pocket, that matters to the American people.
Don't we lose some of those dollars if we continue to see 3% plus inflation on top of the inflation that we saw during the Biden administration? Prices continue to climb for everything from food to housing. Isn't that a concern if we continue to cut rates, that we throw more fuel on that inflation fire?
Well, actually, food prices have been down. Energy prices have been down. We've heard over and over again, our Thanksgiving meal is going to be less than it was under the Biden administration. So while we have seen oftentimes that some prices have gone up, whether it's in beef and some of the other sectors. We have seen housing. We certainly want to address the housing costs because people want to be able to afford their homes. I think the Fed rate cutting will give us exactly that. So I'm standing behind the president on this. I think we need another rate cut. It's been a little bit
Secretary, again,
too long down that runway, but we need to cut that rate.
Part of what you're saying, you want to cut the rate because you want more private sector hiring. We hear you loud and clear on that, but we have to say this latest jobs report, government jobs grew. Do you want to see that reverse? Why is it growing when this is a government that's been trying to cut back on what you say was a Biden administration that only supported the economy through hiring via the government?
The government jobs haven't grown. The only portion of government jobs that has grown in this last report that is showing have been at the state and local level, not at the federal level. Over 2 million private sector jobs have come online, and that has been for native-born. We are seeing massive amounts of the private sector. Out of these 119,000 jobs, 97,000 of those were in the private sector. We're going to do more and more with the private sector to grow this economy, opposite than what the Biden administration did, where they were all federal jobs. That isn't what the mandate was when they elected President Trump. It was to grow the private sector economy. And that is exactly what's happening.
One of the other things the president is talking about is sending middle to lower income Americans rebate checks from the tariffs, which have been behind a lot of the inflation that we've seen. So giving some of that money back to those earning a little bit less. Do you support that, $2,000 check push?
Well, certainly the president has been in consultation with his economic team. I think this is one way to give back to the American people. You know, people work hard for their money, and when they provide that to the government, they have a contract that's going to be spent wisely. These dollars, though, are coming in from tariffs to give back to the American people, and I think that that is a good plan that the president has set forth. He will continue in consultation with his economic team, and what he determines. You know, he's a man of the people. I say this, you see on my building, I hang his banner because he is the president of the working family. He is the president for the men and women of this country. Every decision I make at the Department of Labor is through the lens of the men and women who have built this country, and they deserve to be taken care of, and that's exactly what the president has been doing.
Ms. Secretary, before we let you go, just quickly, I know we're looking for a little bit of guidance on some of the tax code changes, specifically who's going to be exempted from overtime tax or who's going to get that overtime tax exemption. Do you have any clarity on that, or at least a timeline of when we can expect the Labor Department to come out with those clarifications?
Well, I'll be working with Treasury Secretary and certainly through the Department of Labor. I would imagine that with those policies in place from the working family tax cut, that we'll start to see stuff in the first and second quarter. But any specifics I don't have on an actual release date. But again, 119,000 jobs, I think, is a solid report. I'll be looking forward to see what the numbers are for November, which will be released in mid-December. And I know the economists all got it wrong on this, and so this is a good for the American people that we saw a solid report of 119,000 jobs.
Ms. Secretary, thank you so much for joining us this morning. That is the Labor Secretary, Lori Chavez-DeRemer. And of course, tomorrow, don't miss another important conversation. Fed Governor Stephen Miron on Bloomberg Surveillance. That will happen at 8:30 a.m. Wall Street time. So those jobs numbers helping to fuel a rally on Wall Street along with Nvidia. Joining us now around the desk is RaeAnn Mitrione, market strategist and founding partner at Callan Family Office. Thank you so much for joining us.
Great to be here
this morning. So certainly the Trump administration is saying this is a really strong jobs number. It is good. How do you look at it when the payrolls figure on the headline basis is really strong, but unemployment moves to 4.4%? Is this as positive for risk assets as is being interpreted this morning?
It's certainly giving a little bit of mixed messaging, and we have to take into account that this is a little bit of dated data. So it's definitely a positive to see these numbers. I mean, much higher than what was expected. Unemployment did tick up. It's good for the market to see that the economy is still strong, that the labor market may not be as weak as expected, but also the impact that that has on potential for future rate cuts. That may not be as positive for what the market was hoping for.
This could be, I mean, it could come either way, right? Good news can be bad news, or good news, as we know, right? Because we want the economy to grow, but we also want rate cuts in this market. One thing that cannot go either way is the AI CapEx story. It has to continue fueling the growth that's priced in. Do you think Nvidia showed yesterday that it is?
Absolutely. I mean, the market has been having some concerns there, right? We've seen this recent sell-off. And expectations were really high for what Nvidia was going to report yesterday, and they managed to really exceed on revenues, on earnings, increasing their forward guidance. It's everything that we wanted to see, we really saw. And we've seen that too with the other tech companies, with seeing Google, Meta, Microsoft, Amazon, all increasing their plans for CapEx spending. That's going to be an aggregate of $380 billion this year, $500 billion next year. So really, we've gotten that support that the demand is still there, that this AI story is still intact, and should continue to be a tailwind for the market.
I have to ask, if you were to change your mind and say, okay, I'm a little bit worried about this, maybe it's gotten frothy, how would you even actualize that view? If you do start to get worried, like if you bet against these companies, that hurts. If you stand on the sidelines, that also hurts. What do you even do? Yeah, exactly.
And you have seen a lot of that. There's still a lot of cash on the sidelines, and I think a lot of investors who have missed out on this, thinking it had already run so much, and then it's continued to run. So you want to have that exposure. I mean, these companies make up such a big part of the index, and if you're not invested there, you really have been pretty far behind. But you do want to play both sides in a way. You want to hedge because, I mean, we saw that recent sell-off. So you want to have some value. You want to have some international. You want to have exposures in other asset classes as well, whether it's fixed income or alternatives. And having a little bit of cash for expenses is a good thing to have on hand, too. But just making sure diversification is part of your strategy.
You know, we can add now to this AI bubble debate the private credit crack debate, right? The Blue Owl saga has gotten pretty dramatic. Which private strategies, which alts are good right now to get into without doubling up on your AI bet? Because it turns out a lot of it really is a data center play.
Right, and you want to have, if you're investing in private markets, you want to look for things that are a little different. I mean, and historically, you have gotten a 3 to 5% premium over public markets for having those investments. And 87% of companies with revenues over 100 billion are in the private markets now. And that's, you're missing out on the opportunity set if you're not invested there. So you want to have some private equity, you want to have some private credit, you might want some real estate exposure, but it's really important who you invest with, because the top tier managers in those markets, there's a much bigger divergence in returns between the top tier and bottom tier in private markets versus public markets. So you really want to be careful about where you're investing.
It does just feel like this extreme moment of concentration. To Matt's point, infrastructure used to be this asset class where you'd say, like, okay, this is great, it's giving you a diversified source of income. But the diversification now looks like AI. Mm-hmm. All the things are so related to that sector. How difficult does it become to just make sure that you haven't loaded up the boat on AI?
Well, and you want to think about that, right? That your equity exposure does include any private equity and any AI-related investments there. And there are differences. I mean, a lot of the AI exposures in the public markets are big mega cap tech companies now. But you have a lot of these breakouts in venture capital companies that could be, the next Nvidia potentially down the road. And so having some investments there and making some, you want to have some exposure in the private related to AI as well, because it is differentiated from what we're getting in the public markets.
RaeAnn, great having you on. Thanks so much for joining us this morning. RaeAnn Mitrione there of the Callan family office. Coming up, Nvidia's $500 billion revenue forecast for coming quarters doesn't even factor in the potential for added business in China. This is the second quarter in a row that they say that. More from our exclusive interview with Jensen Huang next. This is Bloomberg Open Interest.
Thanks to Jensen Huang, and thanks to payrolls data, much delayed payrolls data, maybe even stale and mixed. We are off to the races this morning. The Nasdaq outperforms up 2% about 15 minutes into your trading day, with the S&P up 1.8%. Some of the top calls this morning, the analyst action that we are watching. Morgan Stanley, they have upgraded Nasdaq to overweight, saying its business transformation is gaining steam as capital markets recover. They're looking at an attractive stock, they say, after underperformance this year. And hey, they now have Walmart over at the Nasdaq, so that's good for them. Shares up 3.5%. Morgan Stanley, they upgrade Apollo to a buy, calling it a top play on private credit among improving macro conditions. The analysts there say that fading rate headwinds and stronger risk appetite should help re-accelerate growth. And finally, Nvidia's blowout forecast is reigniting the AI trade. Everywhere you look, analysts say that demand for Blackwell chips remains red hot. JP Morgan, they say Nvidia is clearly gearing up for significant upside in the coming quarter. Shares up 4.2%, erasing the past 7 days of declines. Now on Nvidia, the CEO, Jensen Huang, speak exclusively with Bloomberg Tech's Ed Ludlow.
Sales are off the charts for Blackwell, and Nvidia GPUs in the cloud are sold out. We got plenty of Blackwells to sell you. We have lots of Blackwells coming. We're making a lot of Blackwells, and we have a bunch of Vera Rubins coming. And so business is very, very strong, but we've planned our supply chain incredibly well. We have the largest supply chain in the world, but we've got a bunch of Blackwells to sell.
Jensen, I tried to go through what the CFO Colette Kress said about China. In the quarter gone, it seemed like there was not meaningful H20 sales because the demand wasn't there, even if you were permitted to sell H20. And then in the current period and going forward, Nvidia seems committed to working with both the United States and China to sell what Colette called more competitive compute. Where do we stand with that? And could you just clarify what Colette was talking about in the current state of play for China?
The most important thing she said is that we've said for some time now, our forecast for China is 0. All of our forecast, the guidance that we showed, Zero. We should start. That's the most important thing that she said. She also said that effectively China is a very important market to us. It's very important to the United States. It's very important to China. We would love the opportunity to be able to re-engage the Chinese market with excellent products that we deliver and to be able to compete globally.
During the call, the US Commerce Department issued a statement saying that you are now permitted to export up to 35,000 Blackwell chips each to both Saudi's Humane and to the UAE through G42. But there are some requirements that the US has of you, in particular around controls of preventing tech transfer to China through the Middle East. What can you tell us about your understanding of what the US government's asking of you there?
That element has been around for a long time, is to prevent diversion. Of course, over the years, people have speculated about diversion. We've chased down every single concern, and we've repeatedly tested and sampled data centers around the world and found no diversion. And so this is an area that will continue to be rigorous on. And there's a lot of different ways to comply. And one of them, of course, is to have it be run by American cloud. Another way is just to make sure that we have measures put in place, whether technology or processes, to ensure that no diversion happens.
That was Nvidia CEO Jensen Huang with Bloomberg Tech's Ed Ludlow. Check out the full interview on your terminal at Bloomberg.com. You can go to YouTube. You can go to Bloomberg Podcasts. You can see it pretty much everywhere, and I'm sure they'll show it a little bit in the next program, Bloomberg Tech, because Ed Ludlow anchors that show that's coming up at 11. Still ahead, we have more on this push in Nvidia, this push in equities and risk assets. This is Open Interest. This is Bloomberg Open Interest. I'm Matt Miller. Quick check on the rally we have on our hands in stocks. We're seeing gains of almost 2% on the S&P. Right now up to 67.56, so clawing back a lot of the losses that we've seen in 4 of the last 5 sessions. The Nasdaq up more than 2% on the Nvidia beat. We had not only that, but a Walmart beat. We had a jobs beat. And you can see really the risk rally pretty much everywhere. The dollar is down a bit, but really little change, and it hasn't been weak to begin with. Nvidia is up another 4%, 5% today. CoreWeave also gaining 7.3%. You heard Jensen Huang saying their GPUs are sold out, and the ones in the cloud as well. Walmart beat as well, also raised its forecast, so Walmart is up 6%. Bath and Body Works, on the other hand, I guess you're not going in there for your bath bombs these days, or if you are, they come from a foreign country, so tariffs hurt somehow. Warner Brothers Discovery, a gain of 2.7%, and Netflix down a little bit, so you can see a mix in the entertainment sector, and we're going to continue to talk about what's going on there. Coming up in the next hour, RBC's Amy Wu Silverman on the back and forth over an AI bubble. Plus, Kathy Bostjancic talks payrolls and the Fed, and the CEO of the largest privately owned infrastructure investment firm, which now we say AI investment firm, will join us from Stonepeak. This is Bloomberg Open Interest. We are 30 minutes into this bullish trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger with Nvidia and jobs numbers saving the market.
I'm starting to feel good again. It's nice.
It's a great feeling, isn't it?
Oh, look at 2% rally. Nvidia's bullish forecast reignites the AI trade and calms any bubble fears for now.
And all that correction talk being quieted as well. We get another boost from stronger than expected jobs report. The shutdown-delayed data suggesting that the economy is still on firm footing.
And Blue Owl's abandoned attempt to merge 2 private credit funds is drawing scrutiny of the firm and its investor appeal. God, it was like the darling of private credit. And like in a 2-day period, that story has really changed a little bit.
It has really changed, going from the darling, the company that everybody envies, to maybe the poster child of fears within private credit.
All right, we're going to talk about what's behind fears, and that is AI, of course. Nvidia's blockbuster results yesterday seemed to lift the weight off of everyone's shoulders a bit. CEO Jensen Huang spoke on Bloomberg Television.
Sales are off the charts for Blackwell, and Nvidia GPUs in the cloud are sold out. We got plenty of Blackwells to sell you. We have lots of Blackwells coming. We're making a lot of Blackwells, and we have a bunch of Vera Rubins coming. And so business is very, very strong.
Joining us now is Amy Wu Silverman, RBC Capital Markets Head of Derivative Strategy. And, well, I mean, if you listen to him, sounds like everything's going great. Do you see positioning indicative of that?
So I would say yesterday was definitely an inflection point for the market, but the positioning going into Nvidia earnings was not all that great. We were pretty angsty. We were angsty on the VIX. We were angsty in terms of hedging. I think, of course, things like Nvidia tend to be a bulwark, and so there is going to be some narrative shifting. But, longer term, Matt, when we think kind of 1 year out, that volatility has stayed relatively sticky, because I do think some of the questions people had about whether or not we're in a bubble, they're not necessarily gone. It's just that the party's going to continue for a little while longer.
If you have those questions, how do you even express that view? I mean, is that the way to go long the VIX further out? Because if you were to try to short any of these stocks, I mean, you'd be in a tremendous amount of pain, especially on a day like today.
Yeah, this has been a huge problem for the investor base I speak with, because when you think about the distribution of risk right now, that right tail, that idea that you're going to get this FOMO and more exuberance, is just as risky to miss out on as getting a sell-off. And so we're seeing it expressed in an interesting way. So we'll see it in the credit market, in Oracle, for instance, or we'll see it in longer dated volatility, but not necessarily shorter dated volatility. And then we'll see it not necessarily in the hyperscaler names, Dani, but we'll see it in sort of the second order names. So like your core weaves, or something that's closer to the idea that if there are cockroaches coming out, maybe they get hit before everyone else.
It's tough, though. Expensive, maybe deadly to short this market. We saw Michael Burry drew his registration from the SEC for Scion. Take a listen to what Carson Block had to say on Bloomberg TV earlier.
If you're out there trying to short Nvidia or any of these big tech names, you're not going to be in business very long. So when I look at AI, you have all these AI adjacent companies, you have these AI player or AI pretenders. That's where you would want to look to short. However, so long as the leaders such as Nvidia are still going up and to the right, I think that would be a very dangerous trade.
Now, the reason I bring this up is because yesterday we were talking to Bob Sloan of S3 Partners, who has, all the short data. And Bob says these are actually the most shorted stocks, the big ones like Nvidia, because this is the only way that investors can hedge this market.
So I would add two things to that. The first is, this is why I've been talking a little bit about this concept of shadow hedging, which sounds a little ominous, but it's simply this idea that there actually is a lot more bearish sentiment out there. Like when I speak with clients, you get a sense that they're a fully invested bear, and they're not expressing it in the options market, even though they'd like to. And so the actual corpus of what I think is out there in terms of demand for hedging is a shadow book. And why that is important is if we start to get downward confirmation, which we actually kind of did in the days leading up to Nvidia, you started to see hedges increase at a velocity that you would not have expected, because that demand was always there. It is just not priced into the market as it stands because of exactly what Carson was saying. And so, look, we're on this Momo train for a little bit longer, but if you start to get the poor data points again, that shadow hedging issue becomes a velocity issue.
So does that speak to a moment of fragility, or not really, if the upside can continue on for a while longer?
I think, look, for now and through year end, because of the data points we got, I think, it's hard to say that short term you're going to have more of these stumbles. However, in terms of fragility, this is something we speak a lot with clients about, which is it does feel like one big trade. It does feel very circular. It does feel very recursive. And because of that, you're not seeing that in the correlations captured by the market, but it doesn't mean that it isn't hiding there. And for those of us, to date ourselves, who can think of the way the GFC was, I'm not saying this is similar, but it's that aspect of correlation where it actually was one big trade, but at the time, it didn't feel like it until things go pear-shaped.
By the way, I was around during the great financial crisis and the internet bubble burst, and we, in neither one of those cases, had this kind of concentration. I think it was Davide Serra who was talking yesterday at our New Economy Forum in Singapore about the fact that we're in a position right now where 30% of the market, the U.S., right, is 70% of the global market valuation. And we've never seen anything like that before. So is this concentration risk all new?
It's not, but here's the other part of that, right? We talk about the K-shaped economy. We talk about how 10% of consumers are doing 50% of spending.
Not sure if that's true.
To be fair, there has been some people coming out recently and being like, that's not exactly what the data shows.
It's still a very high quartile of people who are doing a lot of the spending. And the issue is, where is their wealth to some effect coming from? It's also coming from the stock market, which is very concentrated. So my point being, you have concentration both in how the market is made up, and you have concentration in who is holding that market. And so if those two things, which I think are, again, more correlated than the market is showing, comes to some sort of stumbling block, then again, that velocity on the downside is something that is not currently captured.
Does it also make it worse that just like retail participation is so high right now, that household ownership of stocks is so high at this moment?
All that stuff's an all-time high, right, Amy?
It is, and the one thing about when you think about retail and how they trade is they tend to be very call exuberant, so they like to own call options, not necessarily hedge, and they also have this tendency to think you ought to buy the dip. And so that's a leg of the stool we've also spoken about, where a lot of the cohort that's trading hasn't had their own GFC. They've had sort of 2010 and on, where positive momentum begets positive momentum, which is another reason why, it's not necessarily that we think the party is over today. It is just the idea that is much more connected in a way that I would still be concerned about that left tail risk.
Amy, wonderful to have you on. Thank you so much for joining us. It is Amy Wu Silverman of RBC Capital Markets. The left tail might still be concerning, but it is a market that is focusing on a right tail of rallying. We're up to, at the moment, we are up 1.6%, nearly 2% for the Nasdaq 100. At this pace, if the S&P can close where it is now, it will be the best day since May 27th of this year. Meanwhile, Nvidia, those continue to rise 4%. By the way, the vice president speaking somewhere saying that the market is going gangbusters because of the jobs report. Maybe that's helping. I think it's probably Nvidia.
Yeah, I would say Nvidia is the answer to that. But far be it for me to tell JD Vance about how these markets work. Let's get a look at what the single stocks moving at this hour are. Walmart is another positive story for markets, raising its full-year sales outlook. The share's up 6.3%, although Walmart and Beth Hammack and some other Fed speakers warning of inflation to come due to tariffs.
Yeah, certainly. And Bed Bath & Beyond saying that tariffs are hurting them too. Not Bed Bath & Beyond, Bath & Body Works. Very easily confused in my defense. Palo Alto, they're boosting their forecast, but shares are down after it announced a $3 billion deal to acquire Chronosphere, which is a cybersecurity company. So those shares down 3.5%.
Cool name, Chronosphere.
Pretty cool, yeah.
Verizon has begun uncool news, laying off more than 13,000 employees, a major step in a turnaround plan led by the new CEO, Dan Schulman, who says on the one hand, they can replace workers with AI, and on the other, they're getting rid of 13,000 with those announcements coming just before the holidays.
Yeah, they say on the opportunities, necessary skill sets as we enter the age of AI, that's where they are concentrating. again, I come back to this with every time we hear a company say that. Is it just an excuse because it sounds bad to be like, we're laying you off because our margins hurt and we want them to look better?
Yeah, and it's interesting also that in this case, it's not really helping the shares, right? Typically, when you fire a large amount of people, in the past, Wall Street has rewarded companies that do that. Not the case with AT&T. Coming up, the September jobs data beating estimates by a long shot, more than double as the data due before the government shutdown trickles in. We hear from economist Kathy Bostjancic of Nationwide Mutual Insurance next. This is Bloomberg Open Interest. Get to high interest now. Look what's making headlines around the world. A portfolio of private credit loans run by BlackRock performed so poorly that the firm waived some management fees, a rare move in the credit world. The CLO breached key tests after loans to companies like Renovo Home Partners and Astra Acquisition soured. The troubles highlight growing cracks in private credit markets after years of aggressive lending. Swiss watch exports fell for a third straight month as President Trump's 39% trade tariff slams demand. Shipments to the U.S., the biggest market for those products, plunged 47%. The levy is set to drop, though, to 15%, but there's no specific date for the new agreement to take effect. Nice watch. Walmart is ditching the New York Stock Exchange after more than 50 years, moving its stock listing to the Nasdaq next month. The retailer says the switch reflects its tech-focused future, and with a market value of more than $800 billion, it's the biggest company ever to make that kind of jump.
In other top news this morning, U.S. jobs growth picked up in September. The BLS released its first major data point that was missed due to the government shutdown. We earlier spoke to the U.S. Labor Secretary, Chavez-DeRemer, in the last hour.
119,000 new jobs. I think that is a solid report for the American people and for the workforce. We have seen over and over again, that we want to have these gains, and it's those investments by this administration and this president, I think, that's what you're seeing come online. So this was a solid report for the September numbers. We'll have to see how November numbers come out.
For more on the report, we're joined by Kathy Bostjancic, Nationwide Mutual Insurance Chief Economist. Kathy, on one side, a headline number on payrolls that beat by a long shot. On the other side, cycle highs for the unemployment rate. Which to you is more important?
Yeah, good morning, Dani. Well, I think both are telling a similar story, that September was better than expected, both the increased 119,000 on non-farm payrolls, and then the unemployment rate, it ticked up 1/10 to 4.4%, but it was really on the back of more people coming into the labor force looking for a job. So that's a good reason for the unemployment rate to rise. And if you looked at the household survey, which produces its own house employment forecast in a sense, or number, that was up 251,000. So it really strengthened on both the establishment and the household survey.
We've got that strength in the jobs market. Beth Hammack was speaking earlier saying that any cuts could support continued inflation or prolong inflation. And we've got growth bets, I guess, coming from Barr, for example, saying that AI is generating significant gains in GDP. I guess there's no reason at all right now for the Fed to cut rates, is there?
Yeah, I think, Matt, this strong employment report, even though it's old, right? It's September, it's quite delayed, and we're not, unfortunately, going to get the October data, and even the November employment statistics are going to be released after the Fed meeting. All of that kind of conspires to, I think, support the hawks, those who say, let's just pause and wait. Let's see how inflation develops. And really, there's no urgency now on the employment side of the mandate for them to go ahead and cut rates because things do look better as of September. And, we'll see how things play out. Our sense is you'll still get rate cuts, but they come next year rather than, coming again in December.
Federal Reserve Governor Michael Barr, just to add to this, saying he's concerned that we're seeing inflation still around 3% and our target is 2%. We're committed to getting to that 2% target. I'm not going to ask whether you believe what he's saying is true, but is that something the Fed is going to achieve, especially as the president is able to appoint the most dovish people that he could find?
So our view is that we do have disinflation in store for 2026. There is still going to be some lingering impact from the tariffs, just as Walmart and some of the other retailers have said that, there could still be some higher goods prices that gets eventually passed through to the consumer. But I think overall what we're seeing is the tariff impact has been rather moderate. And as we go forward into 2026, the impact fades. And we talk about AI. Now, right now, it's really all about AI CapEx. I don't really think we're getting the real dividends from productivity gains. But that said, right now, productivity growth is still rather solid. And that's a disinflationary force for the economy. And also, in today's report, average hourly earnings were only up 0.2 on the month. Usually they're up 0.3. Like that's been the trend. So if we're seeing a little bit of easing in wage pressure, that's also good for the inflation pressure and the picture going forward to next year.
Hey, Kathy, I asked this to our Michael McKee, and I don't expect you to have the answer for this, but it is curious that the calendar, and you mentioned this, that it'll go, we have a Fed decision on the 10th, and then on the 16th, we get that much delayed jobs number, and we just don't really know, besides from private data, what things look like in between there. Why can't the Fed just delay their meeting? Isn't this a really important piece of information for them to base a decision upon for their December rate cut, or keep things as normal?
It's a great question. It is really important to see the employment, figures and also the inflation figures as well. But these things are set the dates, and I don't know the legality around changing them. It's a great question, but my sense is it won't be changed. They're going to stay to this calendar, and really we'll have to probably wait until January. Now, there is some case, I guess, with average hourly earnings being a little weaker. I noticed the odds for a December rate cut actually ticked up a little bit this morning. Maybe, lack of wage, inflation pressures. But my sense is, the hawks are really going to keep this, committee divided, and they're just going to have to punt and see how things play out next year.
We have a real concern about this K-shaped economy, and I think it was highlighted during the shutdown. Not everyone knew that, more than 40 million Americans were on food stamps. We have the highest level of subprime auto loan defaults, or payments that are 60 days late or more, since record keeping began. Do you think it's a good idea to send $2,000 checks to the lower quintiles here?
So, I think the first thing is I'm skeptical it would get through Congress, right? They're focused and concerned about the deficit. I think, being able to target certain households, that could be another hurdle to get through, to be able to do that. You could make the case, again, based on the K-shaped economy and those in the lower K, they do need some relief, but they will be getting that with the fiscal stimulus coming with the One Big Beautiful Bill Act. A lot of them will get relief from extended child tax credit, no tax on tips, things like that. So my concern would be you don't want to, especially with the hawks worried about inflation, you don't want to overdo it with stimulus and payments. Treasury Secretary Besson said maybe there's a way we can encourage them to save it. I don't know how you enforce that. My concern would be it would be spent and maybe temporarily keep inflation elevated.
Kathy, great to get some time with you. Really appreciate you joining us. Kathy Bostjancic there of Nationwide Mutual Insurance. Tomorrow, by the way, don't miss Federal Reserve Governor Stephen Miron on Bloomberg Surveillance at 8:30 a.m. Wall Street time to get the view of someone who thinks the neutral rate is much closer to zero.
And still ahead on the show, we get back to AI and infrastructure. We'll speak with the infrastructure giant Stonepeak. Mike Dorrell, again, it's the largest privately owned infrastructure investment firm. What does he think about the frenzy around AI infrastructure and its financing? That's coming up on Bloomberg Open Interest. You're watching Bloomberg TV.
going to check on the stock market right now, and it is not at all depressing if you're long. We are looking at a rally here. Nvidia right now up almost 4% after the earnings and the forecast. That's really helped ease concerns for everybody. But most importantly, you know, where, 37% of the weight is concerned, all of these mega cap tech stocks are up. On the downside, you do have a couple of moves on a takeover, AbbVie and Abbott Labs down, Netflix also off, and you've got Palo Alto. So this is all like M&A news weighing on these guys. In terms of the industry groups, Joe is back, so we're going to get this right. This is today, the 11 industry groups in the S&P 500. You can see the hyperscalers are the biggest gainers, 2.5%. IT up 2.5%. Consumer discretion rising more than 2%, and everybody else is up. Coming up, Mike Dorrell of Stonepeak says the U.S. is red hot for infrastructure. He joins the show next.
This is a really important time. You're seeing an exponential growth in the amount of compute demand necessary for AI. You're seeing an exponential growth of adoption and use of AI, and the number of applications that are going to be using these AI is also growing.
Nvidia CEO Jensen Huang speaking on Bloomberg after the company delivered an upbeat forecast expecting to benefit from $3 to $4 trillion in AI infrastructure spending by the end of the decade. Joining us now is a man who knows AI infrastructure spending very well, Mike Dorrell, Chairman, CEO, and co-founder of Stonepeak. It is the largest privately owned infrastructure investment firm in the world. And Mike, I think we should remind our viewers that at least, since 2017, you've been investing in data-related digital infrastructure back when people weren't looking at it at all. So you've been in this space for a while, and now everybody wants in. There's a frenzy, be it financing, be it owning the data center players so far. When you look at it, do you get concerned with this kind of pile-on that's happening? Are there pockets of froth that you maybe take a step back and are concerned about?
There is a wartime level of spending going on today in data centers and AI. I am a true believer in the staying power of AI. It's a lot of people, and I'm the same, look at the internet and say this is a very close parallel to what we saw with the internet. I think undoubtedly when you see this level of growth and this level of spending, just common sense tells you there's going to be speed bumps along the road, no doubt about it. And so as an infrastructure investor, what we're trying to do is give a somewhat lower risk way to play that trend. And so we're always investing behind long-term rental contracts with the big hyperscaler tech companies. So from that sense, I'm rather relaxed about the way we're playing.
I got to say, because I hear this frequently of folks saying, we're not taking AI risk, we're taking meta risk, we're taking Oracle credit risk. Mike, what happens if that changes? Oracle CDS spreads, for example, have started to widen recently. They've doubled in the past couple months, of course, to a level that's not crazy. But the market is starting to price in more risk for some of these hyperscalers. Is that a problem even within itself of taking risk on these companies that are so concentrated and spending so much money?
I'm not too worried about taking credit risk on the biggest companies on the planet, Meta, Google, Amazon, etc. There's obviously a different way to analyze the more startup LLM companies. That arguably is a different type of risk profile. And so I'm probably more relaxed just from a pure credit perspective about taking the $1 trillion plus big tech companies. There is, though, so much funding needed to continue to provide all the capex for all of this AI stuff. It's like in the hundreds and hundreds of billions of dollars. And that's what everyone is watching. Everyone is saying, hey, is the tap at some point going to be turned off from a capital markets perspective? So that's what I probably would keep my eye.
Well, the root of it is the data, right? I mean, I got hired at this company in 1999, and we were also excited with the fiber cable getting laid out all over the place, paying as much as we possibly could, right? Because internet was going to be the next big thing. And internet was the next big thing. And yet, we still laid way too much fiber, hundreds of thousands of miles of dark fiber for years before that demand really showed up. Could the same thing happen here?
There are absolutely parallels between the internet era and the AI era, and I do think it's yet to be proven which business models are going to work in the world of AI. There's no doubt in my mind that there is enough, if you just look at the cost savings from a labour standpoint, for example, there's no doubt in my mind that all this spending over time will earn a return just from labour savings alone. Now, whether or not the folks who are spending that money are the ones who get the savings or get the earnings from those savings, I think time will tell. I will make one big distinction, though, between the internet boom and the AI boom. The internet boom was a whole bunch of startup internet companies that had no internal funding ability. All of their funding was external. You got very much the opposite story with a lot of the AI companies. You've got the biggest companies on the planet with the biggest cash flows on the planet that are central to all the spending on AI. So I do think it's more robust than the internet.
I mean, they're going to keep buying picks and shovels, these hyperscalers, but are they going to strike gold is the question, right? Or does it take them 10 years to strike gold, which is what we saw happen from 2000 until we didn't really recover that spend until like 2013.
Well, I think if you're Google or Amazon or Oracle or one of these big cloud companies, you're going to do very well in your cloud business, just from basic cloud, but AI is going to put fuel on the fire there. So I think they're already printing money from an AI perspective. But your question is very pertinent. And what happens in all of these big gold rushes is initially it's all about growth. Whoever's growing the quickest gets the stock price shooting up. Eventually, people look at return on capital. That's where things will get to ultimately. And it's just a question of, is that next month or in 2 years or in 10 years' time?
Well, this goes back to what you said before. Maybe the thing to keep your eye on is whether capital markets stay open for these hyperscalers that are tapping them to fund. What are the potential things that would cause capital markets, be it private players who are financing this, be it broadly syndicate markets, that would cause them to step back and maybe not as willingly price some of this debt?
I think the big one is simply market sentiment around, am I happy to keep funding growth with a future promise of returns, or do I actually want to see returns? Now, if you look at a very good parallel is, say, the fracking boom in the US, where this is all the oil and gas drilling, where for years and years, it was all about, can I drill more oil? Can I drill more gas? And then ultimately investors said, hey, where are the dividends for me? So when I turn to the tech world, I do think tech investors are willing to bet more on the come. In other words, I think tech investors, just by their very nature, are willing to invest on a longer time frame. But it's that sentiment change from growth to return on capital. Maybe the other thing I would throw in there is that if the AI tech hits a speed bump, like if it doesn't deliver the sort of improvements that optimistic people are saying it will deliver in short time frames, that as well may cause a bump in the road. I do think long term it's going to be it's going to reflect the true belief that so many of us have, but it's so hard to tell the little cyclical path it'll take to get there.
Mike, power bottlenecks were pointed out nice and early, and investors have really piled in to those plays. Where is the next investable choke point in AI? Is it like transmission, interconnects, firming, gas storage? Like,
it's all of that. So I believe today that the best way to play the power constraint in AI in scale is through natural gas in the US, simply because you can invest in that today. It's very scalable. All of the power that we need to power AI, an awful lot of that is going to come from natural gas. There's really 4 big bottlenecks from a power perspective. Firstly, it takes a long time to get the generation units. If you want to build a power generation unit today, you've got to go and buy the actual turbines from Siemens and GE. You're lucky to get one in 2028 or 2029.
Long waiting list.
Firstly.
Yeah.
Secondly, so many projects want to get on the grid because not only do you have all the AI-related power projects, but all of the renewable projects as well. It's 3 to 5 years to get on the grid today. So all of the operators of the grids around the US, they're looking at ways to speed up your ability to get on the grid. That's a big one. The opposition from the administration towards renewables is actually a constraint on AI power at the moment. The quickest way to get power on the grid is solar. And so you're seeing two policy aims run into each other where you've got really, really strong policy support for the growth of AI. We want to make sure we're staying ahead of the rest of the world. But on the other hand, you've got policy, what's the right word, constraints on renewables in the US. I do think that there's maybe some grand bargain to be had between Republicans and Democrats around that, which brings me to the last constraint, which is the transmission grid. It's very difficult to get permitted to build new transmission grid. And we've got very close a couple of times federally to streamlining the permitting process. And I do think there's a bargain to be had where the Republicans say, hey, streamline this process for us. And the Democrats say, fine, but ease up a little bit on renewables. So that's the way I think about the power constraints today.
That's fascinating.
Yeah, really interesting, Mike. You have to come back. We have to do this again. I know you invest in more than just AI, but topic of the day.
Topic of the day.
Exactly. Mike, thank you so much for joining us. Mike Dorrell of Stonepeak. Coming up on the show, more on AI. But Nvidia, the focus there, their bullish forecast. We're going to have more on our exclusive interview with CEO Jensen Huang. That's coming up next. You're watching Bloomberg. Nvidia anticipates $500 billion in revenue as demand for chips grow. CEO Jensen Huang explained that the revenue target was that with Bloomberg Tech's Ed Ludlow.
Sales are off the charts for Blackwell, and Nvidia GPUs in the cloud are sold out. We got plenty of Blackwells to sell you. We have lots of Blackwells coming. We're making a lot of Blackwells, and we have a bunch of Vera Rubins coming. And so business is very, very strong, but we've planned our supply chain incredibly well. We have the largest supply chain in the world, but we've got a bunch of Blackwells to sell.
Jensen, I tried to go through what the CFO Colette Kress said about China. In the quarter gone, it seemed like there was not meaningful H20 sales because the demand wasn't there, even if you were permitted to sell H20. And then in the current period and going forward, Nvidia seems committed to working with both the United States and China to sell what Colette called more competitive compute. Where do we stand with that? And could you just clarify what Colette was talking about in the current state of play for China?
The most important thing she said is that we've said for some time now, our forecast for China is zero. All of our forecast guidance that we showed, zero. We should start. That's the most important thing that she said. She also said that effectively China is a very important market to us. It's very important to the United States. It's very important to China. We would love the opportunity to be able to re-engage the Chinese market with excellent products that we deliver and to be able to compete globally.
During the call, the US Commerce Department issued a statement saying that you are now permitted to export up to 35,000 Blackwell chips each to both Saudi's Humane and to the UAE through G42. But there are some requirements that the US has of you, in particular around controls of preventing tech transfer to China through the Middle East. What can you tell us about your understanding of what the US government's asking of you there?
That element has been around for a long time, is to prevent diversion. Of course, over the years, people have speculated about diversion. We've chased down every single concern, and we've repeatedly tested and sampled data centers around the world and found no diversion. And so this is an area that will continue to be rigorous on. And there's a lot of different ways to comply. And one of them, of course, is to have it be run by American cloud. Another way is just to make sure that we have measures put in place, whether technology or processes, to ensure that no diversion happens.
That was Nvidia CEO Jensen Huang with Bloomberg Tech's Ed Ludlow in an exclusive interview last night after earnings. Joining us now to talk more about this is Bloomberg macro strategist Michael Ball. And there's so many, I mean, it was such a good interview. There's so many fascinating threads to pull out of that. One of them is the constraint put on the growth of this company by the Trump administration, and whether you look at it in terms of regulation, stopping them from selling their most advanced chips to China, or if you look at it in terms of, policy, as Mike Dorrell was just telling us, that slows down data center constructors from using, for example, renewable energy. What do you think about that?
Yeah, I think it's true, and I think we have to think about two sides too, because China themselves wants to build their own ecosystem and their own chips, and you've seen some progress there. And they're also using a different approach with the open source kind of, algorithmic
But fewer
programming.
constraints, Michael.
Yes, true. And that's another thing. And this is when we get past the immediate build in the West, which is obviously focused in the US and China now, and we think about how market share is going to look for developing nations and EM and Africa. China may have an advantage here in some ways. So you're right. But we also have national security considerations. And this is why there's kind of a little bit of a juggling act. And as far as your PowerPoint, absolutely true. We should be building out as much power as possible. It's actually a little ridiculous that we try and corner the market in certain ways and spin it so that some things aren't as good as others. Power is power. We need to get as much as possible to build this out, or everyone else is going to be paying more, and we're already starting to see that, and that's consumer inflation, and that's a problem for everything else.
Well, for now, the reason that this thing can keep going, whether it's a bubble or not, is that Nvidia is getting so much revenue because everybody is spending so much money. You've been writing about the idea that one of the ways that this is being hedged is through CDS for Oracle, that some of the debt. Does this kind of become this thing where if you start to get worried about AI, debt gets repriced, and then it makes it harder for these hyperscalers to go into the debt market, raise money, and finance some of the spending that they've been doing? Like, is the beginning of this even maybe a problem for Nvidia at the end of the day?
We're in the early innings for sure. And I think it was good that Ed asked about the recycling of capital back out, because if they have about 50% of this $3 trillion spend, they're going to have such a concentration that they need to figure out ways to get out. But separate to that, directly to your question, credit markets right now are fine. We've actually had quite a good pulse this year. It's all been kind of rolling, not new issuance necessarily growing the pot. It's just basically private credit has stepped in to attack some of that. But overall, moving forward, to your point, that becomes a problem when we look at the numbers. And the numbers don't add up in past 26. I think we're okay for a few quarters, but then they start to really get a little bit more ramped up. And alongside that, we're getting the fiscal ramp up with higher coupon issuance from the Treasury. So it is going to be crowded. Right now, we still have sort of the balance sheet space and the demand for it. But yes, the picture will change sometime next year, and this will be more of a talking point.
How much does the liquidity increase that we've seen recently sort of, I guess, mute that problem? Because there's so much demand for credit, as you've been pointing out for a long time. That's what keeps spreads so tight, right? But that's also why everyone's pouring into the Blue Owls of the world.
Yeah, and it was interesting yesterday that Blue Owl kind of had their moment in the sun as far as being exposed a little for weaker links. And I haven't dug into that story. I haven't looked at their balance sheet, so I want to be careful what I say here. But obviously, if we have a concern that the job market is cooling and that the labor market will then weigh on consumption, that will have repercussions for all growth. And then the AI trade itself is not necessarily enough to hold up the economy. So let's be clear, like we've obviously used the kind of lazy terminology of K economy, but we're all in the AI trade anyway. The wealth effects that's holding up that top 20% is coming from the AI gains in a lot of ways through the market. If that all starts to come unraveled at the same time, then the weaker hands and the more speculative lending will come down and the BDCs will be in trouble. And I think that's what people are sniffing out.
Michael, this has just been so fantastic, as it always is. Michael Ball, thank you so much for joining us. Coming up, we're going to have more on that story with Sri Natarajan on Blue Owl sputtering in the face of concerns over private credit, which has increasingly been funding the AI boom. We're going to discuss that next. This is Bloomberg. Blue Owl has called off a merger of two of its private credit funds after scrutiny over potential investor losses from the move sent its shares tumbling. Co-founder Craig Packer placing the blame on negative articles about private credit. Bloomberg Chief Wall Street correspondent Sridhar Natarajan joins us now. And Sri, this is something that we've heard from Blue Owl constantly on this program too, when Mark Lipschultz has joined, saying it's not fundamentals, it's technicals, it's issues with how we're being treated in this equity market. Is it that? Or Are there some real concerns, be it about Blue Owl itself or the structure of what they were trying to do with these BDCs?
Look, the timing couldn't be worse for them because you have to go back to the kerfuffle from last month when Jamie Dimon talked about the broader concerns in credit markets. He didn't name any individual firms. He didn't even talk about private credit. But it did make a lot of big participants and players in the private credit market very touchy. Mark Lipschultz famously came out and took a swing at Jamie Dimon and said,
I remember very well.
You were there on stage. You know, when he talks about the idea that there are more cockroaches, Lipschultz says you will find that in the banking system, not in the private credit system. So fast forward a month and you have this situation play out with Blue Owl. And it is really fascinating. They had a non-traded BDC invested in private credit markets where redemptions were continuing to rise. They were honoring all those redemptions. But suddenly when they had this plan to try and merge it with a public vehicle, which would have forced them to pause all redemptions, and then when the existing investors moved into this new vehicle, this publicly listed vehicle, they could have withdrawn, but a massive discount to book value because that's where it's trading. It's trading at a 20% discount to book value. And that starts to feel a bit icky. So first thing, the fact that Blue Owl called this off sounds smart. Craig Packer yesterday, in fact, was defensive about it, but he did say that initially when they thought about this, the publicly traded BDC was trading close to book value when they thought about this back in early summer. Unfortunately, now it's a 20% discount. It was not looking good. And I think it's good for them to say, not now. Let everyone breathe calmly. We'll come back and see and assess the market and figure out what the next best step is for this market.
By the way, Packer wasn't wrong. There have been negative headlines from, negative storylines from other really big names, like Jeff Gundlach on the Odd Lots podcast. He said that this is garbage lending, not talking about Blue Owl specifically, but he said the next big crisis in financial markets is going to be private credit that has the same trappings as subprime mortgage repackaging held back in 2006. And he said, there's only two prices, 100 or 0. And I think he was talking about BlackRock and Renovo there. But there are concerns, the animal spirits are not great right now.
Yes, look, Craig Packer was talking about the negative headlines, but the negative headlines have been coming off people pointing out some serious issues in the market. And again, when we have this conversation, and the conversation that's truly captivated Wall Street is when the cycle turns, when there is going to be a real credit crunch, would the big problems be in private credit? Would the big problems be in the banking sector? Goldman Sachs president John Waldron very clearly pointed out, there's no difference, guys. It's all the same lending system. But the reason we tend to focus a little bit more on the private credit system is the growth we've seen in the last few years. With so many funds flush with cash, you have this feeling that they were all competing intensely for a limited number of deals. What that means, and the risk there is, were their guardrails eroded? Yeah. And could there be more risks taken that look ugly when the market turns?
Sri, great having you on Bloomberg. Sri Natarajan from Bloomberg News. That does it for us today. We'll see you back here tomorrow.